Hello, everybody, and welcome to the fourth part of our series on raising non-dilutive capital. Today, we're going to be covering a very new and I think innovative form of capital that you can acquire through crypto loans. And I've got a couple of speakers lined up for you who are going to be joining us in just a minute to give you that perspective. Before we jump in, though, let me just tell you very quickly Seedstars, who we are. So we have two sides to our business. We have the community, where we basically run initiatives to support entrepreneurs and accelerate ecosystems, so emerging tech ecosystems in the developing world. And we have our investment arm, Seedstars Investments, Seedstars Capital, where we're investing venture capital in high growth companies all around the world. We've noticed, as you've seen, we've made 75 investments, and we've noticed more and more those companies raising not just equity, but raising debt. And this predominantly debt, but other forms of non-dilutive capital can be extremely important in the growth cycle of a business, and also has the advantages of being, as it says, non-dilutive. So you're not giving away equity in your company when you raise this capital. We've already talked about on-balance sheet funding, off-balance sheet funding, revenue-based financing, and in this part today, we're going to be talking about another form of debt, leveraging the crypto assets out there in the world. We're going to first hear from the enabler or investor perspective, who is from Goldfinch, so Sam, and then we're going to hear from a startup perspective, Luis from QuickCheck. So really excited to invite both of these gentlemen here today to give you the lowdown on how this works and how you can leverage it in your organization. So without further ado, let's jump straight into it. And I'm going to invite Sam to join me here. So Sam, here he comes. Hey, Sam, how are you?
I'm all right. Pleasure to be here. Thank you.
Thanks so much for joining us. So maybe just to introduce Sam to everybody. Sam, you started off your career back in UBS and Goldman Sachs in the sort of credit risk management side, and then found yourself in Kenya with Eyob. And I think from then on, back in 2015, you've been really focused on emerging markets. And we got to know each other when you were with Lendable. So you were principal there, where you helped build and raise their first funds. It was a 100 million fund, if I'm not mistaken. And we actually had Lendable on our first webinar. So, all part of this, I think, small ecosystem providing debt to emerging market companies. But then earlier this year, you've made a change. So you've moved over to Goldfinch, and really exciting company. You've got some fantastic investors on board, Andreessen Horowitz, Coinbase Ventures, but also I think from the impact investment space with Mercy Corp Ventures. So a real kind of blend of a high growth company built on the blockchain, but I think leading to some incredible impact. And delighted to have you here, Sam. Would love for you to take the floor and tell us a bit about how Goldfinch works and what you guys are doing to I guess, provide liquidity to early stage tech companies.
Yeah, absolutely. Absolutely. More than happy to. Here we go. Thank you very much. So yeah, with respect to Goldfinch, we're basically working from solving one core tenant and essentially trying to bridge capital into the real world, really to solve two productive use cases. So one, with regards to the core tenant, is everyone on the team has just basically like a backstory driven or revolving around like wanting to or being involved in financial inclusion. And on the back of that, with about half our team having been essentially ex-Coinbase engineers, essentially the genesis of what we were building was with regards to the two aspects that we're solving for. Is on one side, we basically been seeing there's been just a lot of capital in the crypto space. People are looking for yield, and essentially people are now looking for new sources of yield. And then what it would mean on the other side, as I've been seeing through the course of my career, and also Charlie and through the Seedstars program, you've been seeing, is there's just a lot of real world productive use cases with regards to helping scale up teams in the global South. And so essentially what we're building and Goldfinch really boils down to how do we bridge crypto into the real world in a way such that people can get access to this capital to build real world things that actually have that add value to their lives. So that's really what we're essentially solving for. And we can go on to the next slide, please. So thank you. So it may seem really basically complicated, but essentially at the end of the day is what are we building and who are we building it for? So essentially, what are we building is we've built essentially our own protocol, but essentially is a place with regards to where people can pool capital, which you can see in the top and bottom here on the right hand side in that picture. And ultimately, there'll be a borrower on the other side of this. So I'll start off actually on the borrower side with regards to like who are these borrowers, who are the people that are pulling the capital out. So our ultimate vision with regards to the use cases for capital that goes out with regards to off-ramping is one day everyone will have essentially a crypto wallet. A crypto wallet will be like ubiquitous, like a phone number. And essentially the reason why that matters is that everyone will have a way to actually help identify them. There's a whole lot of work that needs to go around that with regards to when to identify someone, different pieces of analysis you need to do associated with that. But essentially what that means is you can actually identify people and you can actually target them directly, whether it's on your own or through other, through partnerships. You can actually lend directly to individuals or lend directly to SMEs in terms of helping them get the access to the capital that they need. But that's our long-term vision. Our nearer-term vision is, well, who would be best placed to actually help deploy this sort of capital to these sorts of people that we really do care about? And essentially, the off-ramps that we actually have, because what we're building essentially is a marketplace whereby the investors in our marketplace are the ones who make the sole decisions around where the capital goes, is that the off-ramps can go essentially to, for example, fintechs, like the fintechs that are in the Seedstars accelerator. It can go to credit funds who need to raise capital in different forms to then on lend to said fintechs, because both paths eventually get to solving the end goal. And essentially, it could even be fintechs who are raising off balance sheet vehicles, or fintechs who are creating lending as a service platforms, whereby like this sort of capital will just be one aspect of the wider stack and the tech stack that's being used to deploy the capital to basically individuals, SMEs, or whatever it might be. And then essentially moving back one step to the middle circle where we have this senior engineer lender. This now speaks to okay, where's the capital coming from? So with regards to what we're solving for on the investor side is we're solving for basically a pool of capital that can be deployed in a unitron structure or just a blended finance structure. There's different terminology for it, but essentially is people have one of two choices that they can make in terms of how they can participate, whether it is an individual or whether it is a family office or a fund. And essentially is investors come to the platform and they can either invest in a senior tranche or a junior tranche. If they invest in a senior tranche, it more or less is you're depositing capital in, you're taking a senior portion of basically every single investment, because you're $1 or $100,000. There's no minimums that comes in. Can be deployed into will be deployed into all of the investments on a pro rata basis. And then on the back of that, for every single individual investment, on the bottom in that purple section, basically you have the junior investors who are the ones who are essentially making the structuring decisions, leading the underwriting, and to essentially taking the first loss with regards to these investments. And the first loss can be as small as 5% of the total deal, but goes up to about maybe 30% of the total transaction. So essentially, people with regards to being investors, you have two options. One is take a senior portion, deposit your capital, whether it's $1 or $100 or $10 million, and walk away. Junior portion is you'll get levered returns on the back of this, but at the same time, you are taking first loss. So therefore, you're also making an active decision with regards to where you want to put your capital, because your capital only goes where you want it. It's not being put into any investment that the platform decides. And then on the backside of this, I'm not sure how familiar everyone is with non-fungible tokens or NFTs, but really what we're building also is a source of liquidity for secondary trading. So, lending in the global south has been ubiquitous as being like very illiquid. So whether you invested a million, 100,000, whatever it might be, essentially it's very hard for you to find, get access to liquidity through a secondary. And essentially, every investment that is made on the platform gets represented as an NFT, which basically is your unique identifier with regards to this is your representation of ownership and whatever your investment is. So those sort of cash flows. So literally what we've created is the ability for people to do at least one of two things. One is literally on day one, you can invest X amount. On day two, you could turn around and sell that investment immediately if you'd like to someone else and get liquidity for it. So there's ability for you to literally be able to say this thing, this NFT is the representation for my ownership in this. So therefore you can trade it on multiple platforms that are out there, for example, OpenSea, or maybe through an exchange that we end up creating or something like that. But also more interestingly is people can come in and actually end up creating baskets of NFTs, or maybe turn it into like a thematic, or in terms of you can say there's been all sorts of investments into SME financing platforms across like Indonesia, Nigeria, South Africa, Brazil, and Mexico. Someone could come in, buy up various NFTs from all of them, package them, and say, if you'd like to have exposure to SME financing fintechs, you can buy that one package. And it's just a direct stream with regards to the cash flows that go through the platform straight to the NFT, rather than being some convoluted, unclear in terms of how many steps the capital goes or where it goes to with regards to getting to them. Because with regards to the NFT, there's always a clear line of sight to the source of truth with regards to where the capital is coming from, and everything is basically can be seen on chain. Which actually brings me to just like two very basic fundamentals around the technicals. One is on is with regards to what blockchain do we use, and then two is with regards to like what currency are we actually using. So there's a bunch of blockchains out there. You have the most, I guess, popular ones are Bitcoin and Ethereum. There's also, Solana, Avalanche, et cetera, et cetera. Just, essentially the key thing to take away is we are building everything that we have on Ethereum right now, as it's one of the most popular ones. This has the possibly one of the most developers that's on it. So there's a lot of interoperability that you can have between different people's projects or their different protocols. And then with regards to the currency, we're using USDC. USDC basically is owned by, it is owned and essentially created by both Circle and Coinbase. And Coinbase is a US-based public listed exchange. Circle is essentially is a team that's been around actually for a good while. And essentially USDC is it goes by the name of stablecoin. There's a few out there, but essentially stablecoins as of right now, they are a way where people are depositing $1 in exchange for getting one digital dollar. It's almost similar to in the mobile money space, where you can deposit one of your local currency, and then you get 1 unit of that in exchange, and then therefore you can start using that digital dollars, CFA, whatever it is, to onwards invest. USDC isn't, just to be extra clear, it's not an actual currency. So it's basically being managed by this team Circle, but as context, Circle is a team that's on the path, essentially working to become actually a US regulated bank, and then there's a few others in the US that are working to do that. So really, yeah, just overall is we're building an ecosystem whereby investors can have composability with regards to their investments in terms of off selling them, can have their choice with regards to taking a more riskier junior tranche with higher return, or a senior tranche that is buttressed by the junior tranche. That's all lent out in a unit tranche or blended finance structure. Borrowers can be fintechs, they can be credit funds, they can be lending as a service, ABL facilities. It's really, frankly, what we're building. There's incredible composability because all we've built is a pool of capital as an off ramp. So there's nothing actually stopping what we built from being used, frankly, in the equity space, infrastructure finance, or anything like that. Any asset class is really fair game right now that we're focused exclusively on fintechs. So we can go on to the next slide, please. So just very quick track record. When did we start? So we started last December in 2020. We really started to scale up around April of this year. And then around May, June, we closed actually our seed round, which Charlie had just mentioned. And essentially from April, June, basically the protocol has brought in about 38 million. I think it's about 39 as of today. We've lent out about 12, the amount that's here. And the teams that we've lent out to is one is Luis at QuickCheck, which he knows business better than I do, so he can speak to that. But the teams that we've just basically, or the teams we partner with, is one, we partnered with one fund, and we actually lent out to another fintech in Southeast Asia. So the one fund goes by the name of Almavest, which I'll speak to at the very end. Essentially, it's a use case of a credit fund coming on to use basically the platform alongside the other fiat sources of capital that they have, so they can mix and match to on lend to different teams across Africa, the Middle East, India, and Southeast Asia. And then we also have Aspire, who is an early partner of ours, basically providing essentially SME financing across Vietnam, Indonesia, Thailand, and the Philippines. And just as of right now, actually, this slide is fairly old. We've basically helped impacted about plus 30,000 people, which I'm sure it's fairly good. We need to rehash that number. If you go on to the next one, please. So it's a very busy slide, but essentially, the thing to take away here really is the top portion is really emphasizing what we've built really has no bounds with regards to the asset classes that we can invest in, because literally we built a pool of capital that can be off-ramped. And so therefore, the decisioning around where to off-ramp that to, whether it's venture capital, credit funds, fintechs, is basically determined by the investors on the platform. But as of right now, the community of investors on here is specifically focused on basically providing capital in the form of credit to, in some way, shape, or form, to teams in the Global South and the US. So you have fintechs that are coming directly to raise from the platform, and credit funds who are also raising on the platform for themselves, or credit funds maybe raising through the platform to invest in deals. And so at the very bottom is literally just a very detailed list of the type of investments that are possible through the platform. But because it's unbound, there's just so many. But here's just literally listing out, you could have credit funds who come on to raise into their main fund, into a smaller maybe SPV sort of fund. They could use the capital to actually buttress their capital stack, whereby they're raising a subordinated tranche, or they could raise a senior tranche to themselves for whatever reason that makes sense. They can do pari passu deals, sub-participations. And then from the fintechs, again, they could integrate this as part of a lending as a service. Actually, from a product perspective, this even could be used for off balance sheet financing, revenue-based financing, and the likes. And the core thing at the bottom we're just highlighting is right now we're staying away from essentially equities, any shape or form, project finance, and anything like that. And then if you go to the next slide, please. And so this is just a very quick, basically everything that we built, what does it actually mean in the context of how long does it actually take to raise? So this is one of our early fund partners. Essentially, what they were able to do was they came on for their first investment, which was to raise 2 million essentially into an SPV. That 2 million would then be used to on lend to different fintechs who are providing SME financing across across LATAM as well as India. And essentially, how much they raised is about 2.1 million. And their end-to-end process with regards to surfacing what they want to raise, what they, speaking to what they want to do, doing, speaking with the community of the investors, was essentially about a 2-week process from end to end in terms of wanting to raise the capital. And really what it means is on August 23rd is when they made the announcement of what they want to do. And in reality, on September 2nd, that was the time that people were basically allowed to actually start filling basically, the quote unquote order book. And actually the 2.1 million actually was filled in just blazing speed, about 30 minutes. So there's just clearly a lot of demand that's out there with regards to like these productive use cases. And so, yeah, they've been a great partner, and we've got them along with the long tail of others that would be coming on.
Thank you so much, Sam. A lot of information. Thanks for the download. I guess the first question I would love to cover is with regards to where the liquidity comes from that you can ultimately on-lend to, or the borrowers, so the startups in the room, I guess, can access. And I was looking up the market cap today of all cryptocurrencies. It's about 2.4 trillion. And I assume that is the market, you guys are trying to provide a means to an end. Versus the other debt funds we've spoken to, the Symbiotics, Lendable, and the others we've had on, who really target institutional investors, pension funds, family office, and that's a whole kind of process unto itself.
Yeah, so it's a great question. Really, I would say two answers there is that while the market cap of 2 trillion is massive, it's still very early days. So that will likely continue to scale as basically a lot of the institutional players start to put more capital to work into the crypto space and looking for different basically strategies to off-ramp that. So the market cap we would see like to continue to rise. And then with regards to, of that 2 trillion, like what's relevant for ourselves. And really the two things that we aim to really solve for is, one is knowing or having a service provider that helps us know who the customer capital, where the capital is coming from, which I think is a key differentiator that we have. And really marketing or speaking to people with regards to people who are interested in real world productive use cases. Because within the crypto space, just like in the global capital markets, you can invest in equities, you can invest in debt, you can invest in distressed debt, all sorts of asset classes. So with regards to ourselves, is we actually have a third-party service provider that actually vets all the capital that can come into the platform, and we're actually building out a way that we can actually help passport people with regards to people who do want to be KYC, AML, and all of that, because that actually isn't something that is ubiquitous with regards to the ecosystem. Because I think at some point, probably soon, there'll just be a lot more access to different investment opportunities if you're willing to go down the path of basically KYCing yourself. So we have a third party that does that for ourselves, who is much more adept at managing people's personal information, which we don't want to touch. And then again, on the back of that is really working with people who actually care about productive real world use cases, because there's lots of people who are out there who are very, very, very focused, which perfectly fine, on different sort of trading strategies, just either within the crypto world or strategies that are related to something that's not focused on providing access to capital fintechs.
Great. So you're obviously, or I mentioned you were before Goldfinch, you were with Lendable, and from a borrower's perspective, what will be the difference, raising debt from someone like Lendable versus through a platform like Goldfinch or one of the funds that is leveraging Goldfinch?
So great question. So I'll give the answer in terms of what technically is different. And then after that, I'll give an answer related to whether or not they come directly to the platform or go through a fund. So with regards to what's technically different, actually there's only two things. One is you need to be able to somehow get the capital out of the crypto ecosystem. And then two, you need to convert that capital in the crypto ecosystem into a currency that actually matters to you. So on one is you have to create what's known as create a crypto wallet. We use MetaMask. I would say it's like a similar concept to in Southeast Asia, or really, or maybe in East Africa, like an M-Pesa wallet, or in Southeast Asia, where you have your wallet associated with like Grab or Ovo or anything like that. So you just need a wallet. Wallets take 5 minutes to set up in this case. And then with regards to the converting the capital that you have in your wallet, you basically need to partner with an exchange. I would say, and then literally what they're doing is they're taking the USDC, which I mentioned, which is the stable coin, and then they're converting that into the currency you need, whether it's dollars, euros, shillings, baht, whatever it might be. Actually, probably not baht, but in any case, the crypto exchange, I would say, is similar to if you're just opening up a new bank account. So they go, a lot of the exchanges have like really long, not long, but thorough KYB processes. So somewhere between 1 and 4 weeks, which is generally like the amount of time it takes to open a bank account. But once you basically have that, you have the two aspects of pull money out of the ecosystem, have someone that converts it to fiat, and then once it's in fiat, it literally can go into whatever bank account you want. And then with regards to the process, essentially, if someone is, for example, partnering with a credit fund that is already raised from the platform, their experience actually means they don't touch. They potentially may not even touch the crypto wallet or the crypto exchange because the fund would have already done all of that. So it really just depends on the use cases of the fintech at hand. So maybe they're doing cross-border payments or cross-border remittances, and maybe they actually do want the crypto because it could be faster with regards to transferring capital between on and off ramps and something like that. But if you were to go directly to the platform, it would essentially be like you could almost it's akin to a marketplace whereby you are posting up your investment. And you're raising it on essentially a best efforts basis, and you need to make the case. Similar to like in the US, we have Republic, where people are coming to raise their early equity seed rounds. You are putting up your business case, you're answering questions, and essentially if people are keen on what you're building and want to support it, they will essentially fund you.
Super. Thanks so much, Sam. I think there's a few other questions on regulations, and I would love to get into that as well. But I think what we'll do is we'll bring in Lewis, we'll have a quick chat with him, and then we'll do some Q&A, the three of us together at the end, and tackle some of those other topics.
Okay.
All right. Thanks, Sam. So yeah, save any other questions you may have for Sam, write them in the chat, and we'll tackle those at the end. I would now, though, like to bring on Lewis. And we'll also put back up the slides. So Lewis is joining us now. Hey, Lewis. Hey, Lewis, can you hear us okay? You're on. Yeah, there you
go. Maybe I was muted.
We can hear you now. Hi.
Perfect. Hello. Great to be here.
Thanks for joining us. So Lewis, I would describe as a sort of tech purist through and through. You've worked as both on the sort of academic side as a researcher, a lecturer, and then you went to CERN, which is, for those of you who don't know, CERN is the particle accelerator here in Geneva, actually where I'm based, and also the birthplace of the World Wide Web. But then after a few years there, Lewis, you shifted gear, I guess, into the startup world. You joined Seedstars actually as our kind of group CTO, and then we shipped you off to Nigeria to start building fintechs. And you've been there ever since. And with QuickCheck primarily, which has now been operating for about 4 years, doing incredibly well. I'm really proud of what you guys have built. And I think one of the only profitable digital lenders that I've heard of. So really impressive growth. But Lewis, you have also been raising various forms of debt, including a loan through Goldfinch's platform. And I would love for you just to take over for a few minutes. Tell us quickly what QuickCheck does, why you guys need to raise debt, and then also maybe a bit about the different facilities you've raised and how that went.
Okay, cool. So great to be here. So QuickCheck, what is QuickCheck and where we started? We started back in 2017 or end of 2016. We were in Nigeria looking at this market, at the opportunity that existed there in the financial technology space. And the challenge that existed in the global south across the board. More than 2 billion people face the challenges. They don't have access to proper financial services. They don't have access to credit, the basic thing that you need. And what we launched back then was a simple digital lender We built some machine learning models. We built an app over a weekend, and we put it out in the world where we were giving loans to people. From there, we started evolving the company, and now it's becoming a digital bank. So if you move to the next slide, you're going to see a bit of what there's another one before. Yes, what we're doing right now. So we started from lending, and from lending we are becoming a credit-led neobank. And the credit-led neobank means what? It means it's a company that we operate as Chime in the US or as Revolut in Europe, where we provide accounts to people. But where we make money is on all the credits, on the credit products, and credit is what we really understand. And this is one of the reasons why we need to raise debt from institutions such as Goldfinch. So what is QuickCheck now? Now QuickCheck has savings, has a product we call Credit Builder that helps people understand. And this is a big challenge because if you look at Europe or the US, people have enough financial knowledge to understand that they need to pay a credit, to understand how interest rates work. But in these markets, this information is simply not there. People don't understand enough about credit. So we built something into our app that helps people understand that if you pay credit on time, you get access to more things. You get access to higher tenures. You get access to lower interest rates. It's really about leveraging the loss aversion and all these biases and all these characteristics that humans have to teach people. Then we have savings like any other bank, and we have phone financing, and we're also launching cards earlier next year. So this is what we are. Digital credit-led neobank. And if you move to the next slide, you get a bit of information of what we've done. We disbursed, now it's a bit more than that. We're like a bit over $60 million of disbursed loans. So around $1.4 million of loans disbursed to date out of 3.6 million applications that we've had. These are people that start with low amounts. They start at $13 to $14, $15, and they grow up to $700 in our platform. This is our main core. It's financing cash, and this is what the numbers are on screen. We also do phone financing with the largest manufacturing phones in Africa. That's called Trenchant, where we finance Tecno, Phoenix brands. And we believe it's a great opportunity because now if you look at, especially in sub-Saharan Africa, people still don't have access to smartphones. So we are going into that at the same time that we're launching all the other neobank products. Talking a bit more about what we did with Goldfinch and what we do regularly, we raise debt from different sources. With Goldfinch, we raised a credit line, a revolving credit facility that we structured via an SPV in Nigeria. So we raised from them a revolving credit facility that needed to be hedged, needed to be placed in Nigeria to be able to on-lend to our customers. And it's the structure that we use here, and this is important when people talk about debt and how you do it. You can put it, as you well mentioned, Charlie, on balance sheet, can be off balance sheet, and off balance sheet can be many things. Our preferred way of doing it is putting it in special purpose vehicles. So that's what SPV means for those of you that never built one. And it's basically can be two ways of doing it. It's either a company that is created on the side, and it's a company that owns those assets, or it can be in some ways that we did it also in Nigeria. We use it via a trustee. So a trustee can be, for example, a larger bank that has a trustee department where they create a trust, and you put all those funds, and we don't have access to those funds, so the funds are safe. And we created this structure, and with this structure, it's the structure that we use to lend to our customers, and then that receives the payments from our customers, and then is the structure also that pays the interest on the debt that we received in the case, for example, for Goldfinch. Maybe I'll pause here and let you take over, Charlie. If you have more questions, Brilliant. Maybe it helps.
Yeah, no, super helpful. Thanks, Luis, for the intro. I guess you're probably one of the few early stage companies I know that have raised multiple facilities. So it's going to be great to get a bit of a comparison from you of how they all worked. So you've done on-balance sheet financing, off-balance sheet through the SPVs. You've done, I guess, local currency. You've done foreign currency, and now you've done the USDC through Goldfinch. So you have a pretty broad spectrum here. If we're just to compare the process and the complications of, and also the benefits, the loan you've done through Goldfinch versus, let's say, a foreign currency loan on balance sheet. Like, what are the sort of pros and cons? How would you what would you recommend to other people looking at this and considering the different options out there?
Now, so by default, I would say that best for any startup is local currency, because you don't have the cost associated with foreign capital. So either it's crypto or dollars or any hard currency. The challenge that you have, if you look at the countries such as Nigeria, that you have a massive devaluation of the currency, is that you need to protect your investor, you need to protect your company, which means you need to hedge these funds. And hedging has costs associated with it, and there's different structures you can use depending on the country where you are. In Nigeria, for example, there are futures, there are non-deliverable futures. If you talk about non-deliverable, means that they're not deliverable, which means if there's no liquidity in the market, like right now, you simply cannot access dollars. And if you cannot access those dollars, you cannot pay your investors, and you have a problem. There's a risk of default there. You can also use back-to-back hedging with banks. That again, that you're a lot more protected, and we can address it if you think it's useful for people. But the main thing is, I would go for local. If you have the option to go for local currency. Then, what is the difference between I don't know, Goldfinch or Symbiotics that was also in here in these webinars? It's the type of capital that they provide. So in Goldfinch, they're providing crypto versus the other players that they're providing hard currency. The process is more or less the same. So we're talking about giving them audited financial statements, looking how the business is going. Goldfinch, at the time that we did due diligence, they were very thorough, looking into all our numbers, ensuring that what we were saying was true. Looking at financial statements, and besides the financial statements, we was going through our management reports, understanding that what we had matched everything matched all the analysis we had done. And this is very important also for all the startups hearing like us. I'm sure that many people are not well prepared when you start in this process. You don't have the right documents in place. You don't have proper audited financial statements. You don't have management reports. You don't have a finance department. Us being a fintech makes our life easier because, well, easy to some extent. We need to have a finance department or else we cannot operate. But all the other ones out there, maybe they don't. And one thing that is essential to raise this type of structure from institutions, you need to be prepared. You need to be prepared for this due diligence, and you need to be able to provide the numbers that they require. Then it's just the currency they give you. Me receiving dollars, USDC, or any other hard currency or crypto is the same. At the end of the day, I will need to convert it to Nigerian naira to be able to lend to our customers.
The fact that Goldfinch is built on the blockchain and I guess has certain advantages in terms of what they can do in the smart contracts or the automation or having the community involved, did that impact the way the loan works for you or the way the underwriting and credit decision was made? And also how you pay it back and
yes.
Any benefits and differences there?
So it's a lot more comfortable, Goldfinch, versus a traditional bank. For example, we are now closing a credit line with a local bank, and now I just received an email with another contract I need to sign. And this has been going on for, I don't know, after being approved, it has been going on for a couple of weeks. Then the funds will finally be transferred to our account one of these days. And this is a fast bank, in case. This is not a slow bank. With Goldfinch, you click a button on their platform, you receive the funds on your MetaMask wallet, on your computer, and then from there you can do whatever you want with the funds. You can move them for Circle, like it was mentioned before, and then you can move these funds across the world. They have rails that people can send US dollars to anywhere, basically, well, almost anywhere. And then when you pay back, it's the same thing. You have the funds in your wallet. You click a button, it's paid. And that's the main experience that is different between them and the bank is the speed. The speed is amazing.
Brilliant. Now that's super helpful. I mean, I think it's important to understand there's all these different options. Couldn't agree more. Local currency removes a lot of the risk. Challenge is there's not always local currency loans available, which is why I guess the likes of Symbiotics, Lendable, Goldfinch, all of these platforms are so necessary. But no, super. You've answered a ton of my questions I was going to ask about, what you need to have as a team. You mentioned the whole audit process, the management accounts. So I think that's very insightful for people watching. So thanks for commenting. If there's sort of one advice you can give to teams who haven't yet raised debt about what they need to get in place, what do they? Maybe it's the financial team or the financial department you mentioned or the accounting. what is it you think that is most critical, let's say 6-12 months before you want to raise debt to make sure you're doing right?
So you need to have the numbers. At the end of the day, raising debt is very easy if you have good numbers. Unlike equity, you need to talk with people, you need to convince them of a story, and they need to believe. If you're raising a Series A or a pre-seed or seed, they need to believe you, right? With that, it's not really that. They need to believe you, fine. They need to look at track records. They need to look at where your numbers are. So you have to prove your track record. And your track record is proven by audited financial statements, by management reports. And then at the end, they go into the bank and they can check what are the transactions in the bank. No investor ever did this with us. Even our latest with one of the big four, they go do and check all the data you have. Again, another due diligence we finished a few months ago. They got to the point of downloading our full database of loans, all the columns, and they ran an analysis on that to compare if the analysis that they did on their Excel matched what we had. So this is what you need to be sure is you need to have full control of your data and have everything documented in somewhere in your database, ideally.
Thanks, Luis. That's another really good insight, I think, and very valuable for people watching. Going forward, as you think about your sort of capital mix and where you're going to raise debt from and how you're going to, continue to fuel your lending business, what's the sort of ultimate or the best case scenario mix of debt that you can raise? Local currency, like would you just gonna go only local currency with the banks, or do you like having a mixture? How do you think about that?
So us being a digital lender, it allows us to do many things. One of the things it allows us to do is we can securitize our own loans. So I can potentially package my loans into a product that gets sold to banks for financing. This is a part of an easy way to do it. Another thing we're exploring is raising commercial paper locally in this case in Nigeria, so that we can support again with local currency, because again for us local currency is extremely important. The mix will be a bit of local and foreign currency. We want to be diversified. In case, as you were saying, that sometimes we don't have access to local currency in the country, that for some reason might block, we need to have access to foreign lenders that can provide this hard currency that we use as collateral for hedging and for getting local credit lines.
Brilliant. Thank you, Luis. I'm going to ask Sam to join us again, and we've got a bit of time for Q&A from the people watching. So anyone in the audience who would like to ask a question, feel free to do so in the chat, and we can flag those questions, show them up, and I'll orient them either to Sam or Luis. So go ahead, please, and start writing in the chat. While people think of their questions, Sam, there was one I had for you that I didn't get a minute to ask about the regulatory environment and how you at Goldfinch look at that, and maybe where your concerns are or where your optimism lies as to how the regulatory environment, which is extremely, I think, young still in the crypto space, may impact you and the business.
Yeah, it's a really, really good question. Actually, I have a positive outlook on it, because the way I would have a negative outlook on it is if basically crypto as a whole were to be basically fully outlawed, banned, and just turned off. So like turning off like a $2 trillion market. It doesn't seem like it's going to be possible. I mean, not possible, but it doesn't seem like it's going to be likely. But overall, I think we're really well placed, because fundamentally I think there's a lot of existential questions from every regulatory body around what's going to happen next. So it's not really it does definitely affects Goldfinch, but it's not Goldfinch specific. But the through line that we want to solve for and that we think will differentiate us is really two things. One is being able to know your customer and know where the capital is coming from and where the capital is going to. And then two, being able to basically represent that everything that you're building really does have a real world productive use case in terms of impacting actual people's lives and trying to make just the world a little bit better. So from a capital perspective, we're already fundamentally differentiated because we do basically have the ability to KYC the capital that does come in, which is not the standard at all. And I would imagine that probably is a way where some, or if not a majority of capital will go down the path of, which would cause like a probably big shakeup in the ecosystem. And then two is just aside from like what our own direct intent, I think it will make for a much better case with regards to ultimately like, why were you doing all of this? It's one thing to say, you're trying to actually help teams grow and scale in the real world versus if you're trying to, add some more profits to a trader's book.
Brilliant. There was same sort of question from Elton in the chat about the regulatory side of it, and I think you've answered that, Sam, from your perspective. Luis, from your standpoint as a startup or a company in market, does that influence the way you report or the way you're viewed by the local regulator, or for you is it just another liability you have on your balance sheet and no one needs to really know where it's coming from and that it's crypto in the end?
So it's another liability on a balance sheet. It doesn't really matter. But it's a very interesting question about that Elton asked about crypto and banks. Normal banks, no. They don't care. They don't understand. Especially banks in many emerging markets, they not even understand. Using securities as a collateral for loan. They don't. You cannot use let's say German T-bills that are extremely safe as a collateral for a loan in Nigeria. Very complicated. Normal banks don't do it. Some merchant banks can do it. So if you tell them crypto as collateral, my God, that doesn't work. On the other hand, there are some banks, especially in Switzerland, there are two that you can work with, and you can place these funds there, and you can potentially do things with them. Will they work with startups? Yes, we had some conversations with actually those two banks. They are extremely expensive. So depending on what you want to do, you might want or might not want to use them. On the regulation side, I think it will not impact us at all. There is obviously challenges on depending on the countries where you are. So China, for example, is banning crypto across the board. So as Sam was saying, that is a risk, right? So people still operate. They still operate in parallel peer-to-peer markets, so it can still operate. I believe that crypto will continue developing more and more, simply because it solves a problem. And until the governments come up and solve the problem that crypto is solving, it's going to continue developing. Then if they all come up and they all build or they all create central bank digital currencies, maybe the crypto that we know it will shift. But until something like that happens, I don't see it stopping. I just don't see it growing and growing more.
Great. Thanks, Luis. I think we had a slide here. I don't know if we can put up the slides quickly, where maybe we'd love to just sort of hand this over to Sam to tell us a little bit, because typically at the end of these webinars, we share potential lenders that, we did the on-balance sheet lenders, the off-balance sheet lenders. Unsurprisingly, there are very few lenders out there working with this type of, cryptocurrency and leveraging blockchain. But Sam, there's two on your platform, Karis and Alma. Karis, I came across the other day making a loan to a fintech in Kenya. So pretty exciting to see that. I think they're relatively new, but definitely, aligned in the mission of providing debt to emerging market fintechs. But maybe you just want to say a quick word, Sam, about how you're onboarding different funds and where you see this going.
Yeah, absolutely. Actually, one other thing I want to hit on ahead of that, because you reminded me about this, I completely forgot about it, is with regards to the composability of what we're building, because Luis mentioned it specifically around ideally you want to have local currency. So whilst we're using USDC, which is basically pegged to the dollar via the Circle basically foundation or Circle, we also have the ability to, and there are projects that are working on this that are creating stable coins for each country. So the functionality is actually there. Now it's a matter of time for there to be liquidity. So there are projects like Terra Luna, which is completely separate to what we are doing, who have basically built a stable coin on the Korean won. And they've built the functionality for there to be stable coins basically for like any country. So basically the tooling is pretty much there. So assuming liquidity, actually starts to flow in, then it actually means that with regards to our off-ramp, we could actually start to convert the USDC into local currency, and then actually have either the teams who want to draw on it or the credit funds who want to draw on it actually draw in local currency. So like, which, you know, for some teams is like an easier proposition of like you deal with the local currency, like, so there'll probably be there'll likely needs to be a lift versus premium associated with that, but just being able to take one more thing off the table of having to deal with that from an FX perspective, potentially. Some teams are just happier to do that, and that could happen probably over the next year or so. But then to your question here is, yeah, so the reason why also funds are coming to us, such as Alma. So just give you some context on AlmaVest and Decorus. So AlmaVest is the first team that we had worked with. One of the founders there used to basically work at the IFC, and CGAP was, you know, part of like a project team that was helping actually launch M-Pesa in Kenya ages ago. So, you know, and I actually was an operator of I think 2 fintechs in India. So the team there has some deep experience in the fintech space. And then Chorus is basically ran by, you know, most, like actually 2/3 of the team are actually from West Africa. So from Burkina Faso and from Togo. One of them was a MTN exec, so very familiar with mobile money. 2 of them actually were working at Juvo, which is a mobile money, just like payments platform, operating across Africa and Latin America. And then one of them was additionally a structured finance investor out of Goldman Sachs. So both of these teams, a lot of like long track record in the context of fintechs, investing, and acting as just generally operators. So it just made sense that they would be really good fits in terms of being, you know, the best sort of stewards who are, you know, they're on the bleeding edge with regards to wanting to interface with basically the crypto world and help stand up structures that can help bring more fintechs into the crypto world. So generally, these are the sorts of teams, and there's a few more like them, where just it made sense as a good fit with regards to their background, willingness to work in the crypto world, and their networks with regards to basically, you know, lending out and being experts in the context of what they invest in.
Brilliant. And so anyone watching, if they are seeking to raise debt, they should go directly to the Chorus and Alma website, right?
Yes.
Brilliant. No, it's super exciting. I think that's a great place to kind of end for today. And I mean, obviously this is a new facility, a new ecosystem, a new technology you're building, but really exciting. I'm yeah, definitely optimistic about where this is going to go and the benefits for early stage tech companies in emerging markets. But thank you so much, Sam from Goldfinch, for joining us, telling us about how you work, and Luis from QuickCheck for giving us the startup perspective and what it's like to raise capital. Really appreciate you being here today. Last message is just to say that this series of webinars continues. Next week, we've got a session on actually grant funding, which is definitely a capital that is also non-dilutive. A lot of it is available at the moment, and there's organizations on that call next week, like USAID, Global Innovation Fund, who provide grants, and then also a company that's actually leveraged that non-dilutive capital fairly successfully. Fuzu will be chatting to you same time, same place next Thursday. Thanks, everybody. Really appreciate you joining us, and yeah, I hope it was insightful. Bye-bye.